Matt, good to see you today. We're talking about 3 RMD strategies to reduce your tax burden. I know you're always thinking of strategies to help your clients reduce their taxes. So let's talk about those required minimum distributions because proper planning is vitally important. Let's start at the top. What are they and how are they calculated?
Good question. RMDs are required minimum distributions. Basically, for most of your life, you've been putting money into an IRA or into a 401k, and that has not been taxable income to you. So at some point, the government says, we want to tax that money. We need our portion, and that's the required minimum distribution. The old age was 70 and a half. If you were 70 and a half, you had to start taking RMDs. As of the last few years, the current age is age 72. So, and that RMD needs to be taken out by basically they calculate it. They look at the account balance as of December 31st of last year or the current year. And then or I should say last year, there we go. They look at your life expectancy and that's your RMD. First year is usually around 4%, give or take might be 3.9 or something like that. And then it goes up from there.
And I know you work really hard to make sure your clients take those RMDs when they need to, because if they don't, there is a significant penalty.
Yes, there is. It's 50%. So
Ouch.
50% of what you should have taken out. So if you should have taken out $10,000, you have a $5,000 penalty. You're not getting
no fun at all.
Yeah.
All right, so let's walk through 3 strategies then to reduce the tax burden that comes with RMDs. And first on your list of considerations, consider early distributions. Why is that?
Well, if you take it out after age 59 and a half, there's no, 10% penalty. But the idea there is to reduce your taxable bucket later in life. If you take it out at 59 and a half, you're going to have your regular income tax that applies to that. But we're reducing your bucket, and then you could take those funds, after going into your savings account or whatever else, and either, build up your savings or build up other, buckets that are taxed at different rates, maybe a non-qualified account where it's long-term capital gains as opposed to income tax rate if you've held those funds over a year. So the idea is just to reduce that bucket into a different tax bucket, if you will, to help have spread it out into different.
Right. That makes sense.
Yeah.
And next on our list of considerations, something that we've talked about, we actually did a separate video on it, Roth conversions. Why do you love these so much?
I love them because the question is, do you want to pay tax on the seed or do you want to pay tax on the harvest? I'd rather pay tax on the seed, right?
Yep.
And with a conversion, RMDs there are no RMDs. So you're not going to have to take money out later in life. But if you do, it's not taxable income. So it's not going to increase your tax bracket.
Okay, good to know. And last on our list of considerations, this is something that I just love because it's a win-win for everybody, a qualified charitable distribution. Tell me about those.
Yes, QCDs. So with a QCD, let's say you want to give to a charity, a nonprofit, 501c3. And the traditional way is you withdraw money from your IRA, you pay taxes on it. You took out $10,000, you pay taxes, and now you have $8,000, and you're giving that check to the charity for $8,000. Well, number one, that increased your income by that $10,000. Number two, you're only giving the charity the $8,000, right? QCD allows the money to bypass you, so you can give direct to the charity. And so now instead of giving them $8,000, you're giving them $10,000. And at the same time, you didn't increase your tax liability. So it's a win-win.
That is great. And again, this all just comes back to strategic tax planning because those RMDs are income. And we talk about it often. A lot of people think they're going to be in a lower tax bracket when they retire, but that's just not always the case.
It is not always the case. And it's rare to actually see that because number one, the government does keep spending money that they don't have, which means we're going to get taxes and we're going to get inflation. So, and the tax brackets can change with the vote of a pen. I mean, they can, decide that they want to increase taxes really whenever they want. And the general rule of thumb is this, people want to know, should I do a Roth conversion or not? If tax rates are 1% higher in the future when you take the money out, then it pencils to take that tax out, to take it out today and do the conversion. If it's the same rate, it doesn't matter. It's going to be the equal amount whether you pay taxes today or pay taxes tomorrow. But you have to ask yourself, do you think by the time, you retire or later in life when you're 85, do you think taxes will be higher than they are now? If it's a yes, then you should do some Roth conversions or do some planning. You should get with an advisor and try to get some help.
I have seen the government's debt level lately, so I do think they're going up. But Matt, this was really helpful to talk through. If somebody would like to, consider these strategies and whether they're right for them, what's the best way to reach you?
The best way is by phone. Our number is 425-256-3105 or email mburklund@choosevault.com.
All right. Matt, thank you very much.
Thanks, Aaron.